Hello and welcome to Compounding Curiosity. I'm your host Kalani Scarrett, and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. Alrighty, my guest today is Matthew Ruber. Matthew is the founder of Enlihtan Capital Management, where he employs a research-intensive bottom-up selection process in order to find excellent businesses at prices which represent excellent business sense. Before Enlihtan, Matthew was a senior trader at Macquarie in Australia and in Hong Kong, and then successfully ran a multi-strategy prop trading business for CLSA, focusing on merger arbitrage, volatility trading, and value-based special situations. In today's conversation, we cover how he melds qualitative and quantitative characteristics when finding investments, asking the right questions of your investments, and some stories and lessons from AGMs and management. So it was a super fun and varied one today, and I know I learned a ton, so I hope you do too. So please enjoy my conversation with Matthew Ruber. Cool. So Matthew, thank you so much for being here today, but maybe a fun one to start before we get into you and your background and your work. What's most surprised you about running your own fund? Like, what do you think is an underrated or underappreciated aspect of your role?
Well, I think probably the fact that there are just so many research rabbit holes you can go down. You simply have to prioritize how to best allocate the only true scarce resource, which is always time. So in the end, it's the only thing that matters. So I suppose what I've tried to do is prioritize time by using techniques like Covey's time matrix, that sort of thing. Where you try and get away from the urgent but unimportant stuff and try to emphasize things which are much more longer term, but of long term strategic importance, but certainly not urgent. So that I would say is probably the single biggest thing. Just the amount of the time you can waste just chasing unnecessary sort of leads. But I suppose an underappreciated aspect of it would be just the sheer amount of time it takes to get from, an inception of some investment idea to an actionable purchase. It can take 6 weeks. I mean, if the company or industry is something unfamiliar to you, it's a very long journey. And what's even worse about that is it can actually come to naught in the end. And that can happen for lots of reasons. I mean, maybe the stock runs up while you're doing the research, or maybe you discover something very negative only very late in the process. It can be frustrating to spend so much time on something with no tangible benefit. But this is the nature of running a high conviction portfolio.
Yeah, so how do you get past that? Is it just knowing that in the long run it'll play out, or does frustration never get the better of you? Like, how do you deal with it?
I think this is probably the single source of productivity gain I can get to. I mean, this really addresses the research productivity issue. And it's not enough to do efficient research. You've got to get to research that leads to actionable buying ideas. You've got to get to a transaction. And it's frustrating because you know that you can't get to a transaction unless you do the homework. There's no easy answer to this. But for lots of reasons, what I'm trying to do, and we can go into aspects of this as we get into this chat, but I am trying to automate aspects of this because it's an endless frustration.
Yeah, so we may as well continue on. What can you automate? What are you looking to automate, and how do you go about it? Yeah.
I think a lot of it comes down to, we're talking about the investment process, I suppose, a little bit, but a lot of my investment process, which is developed over a very, very long time frame now, but a lot of it lends itself, I think, to breaking down all of the big decisions into smaller chunks. And I'm a big fan of scorecards. So what I've decided to do is, over a long period of time, try and remove some of these sort of biases by breaking all the big questions down into lots of little questions, figuring out weighting schemas, and trying to assign some sort of quantitative metrics to them all. It's easier said than done because a lot of this stuff is quite qualitative, and I think the progress will really come from finding quantitative analogues to qualitative questions. That's where the progress will come from, and I'm always sort of heading in that direction. But it's very difficult. You can sometimes get a lot of false precision in this sort of business. You think you're measuring something, but you're not really measuring it. I mean, it's really a false metric. Just because there's a piece of data doesn't mean there's an insight.
And you've brought up qualitative and quantitative. I'd love to talk more about your background, and because it's a bit different, and you've gone from prop trading, I think, to where you are now. I'd love to hear more about how you've gone about it, what you've learned along the way, and yeah, just walk me through it, I guess.
Yeah, so I studied lots of mathematical finance at uni and loved all that stuff. So I naturally sought out a role that did something with all of that learning. And I got a job in as a derivatives trader at Macquarie Bank. Straight out of uni, and so that was great. Lots of fun. I mean, lots of opportunities to apply, quantitative techniques to arcane sections of the market. I mean, it was great. But in terms of the investing process, so investing money, less about sort of market making or arbitrage or any of those sort of things. Actually, attempting to make an investment decision. I mean, I think that all of those skills that I learned at uni were great, and some of them are, I continue to use now. But I did suffer from a man with a hammer syndrome. The old saying that to a man with a hammer, everything is a nail. And so the issue with that is that you've got this lens where every time you're looking at an investment proposition, you're trying to put it through this sort of quantitative lens, and that doesn't always work. It helps. So you can do lots of clever things with quantitative techniques. You can apply lots of screens, that sort of thing. You can filter the universe of possible ideas down into a tractable subset, that sort of thing. But what I found, the turning point for me with all of this was getting more involved with the readings of Warren Buffett, and I knew about Buffett. I mean, I was following Buffett for years, but from a context of, because Buffett was actually in his Salomon days and pre-Salomon days and post-Salomon days doing a fair bit of arbitrage himself. Used to play around in convertible bond arb, and that was like a cornerstone of things that we did at Macquarie Bank. So I was just naturally interested in smart players like that and what they were doing, but I had no idea what he was in terms of an investor. I'd never read any of his manual letters or any of that sort of stuff. But in 1997, I got around to doing that, and I read every single letter slavishly, and developed an investment process around that, based on that. And that was great. That was profoundly qualitative. So I kind of had this huge shift away from like a quantitative mindset to a much more qualitative process. And now I'm almost going full circle because I'm sort of trending back towards more of a quantitative attempt at the qualitative. But maybe that's just the order things have to happen in.
That's a great journey, but I'd love to know just like what led you to Buffett. Like, was there always that qualitative itch? Did you always want to sort of understand businesses better?
No. So what happened was around the 1997 timeframe, a colleague of mine gave me Roger Lowenstein's book, The Making of an American Capitalist. And I read it, and I thought, this is very interesting. This guy's got a lot of interesting ideas, and just the whole approach, and the references to Ben Graham, all this sort of thing. And so I read I read the Ben Graham Intelligent Investor book, and then I read every single Buffett letter that was ever written, and a whole bunch of other books about Buffett, and that whole sort of era, and also the people that Buffett himself recommended that you read, which are people like Philip Fisher's book, Common Stocks and Uncommon Profits, and read all of that, and just refined my investment process around that. And it's interesting to look at that. That's quite a journey as well, because I remember just thinking, okay, look, can we take some of these ideas? There's lots of ideas. I mean, there's lots of lessons. There's lots of things Buffett did over the years, and there's lots of principles. And I stress principles. They're things that are fairly invariant, but they're difficult. They're difficult to translate into hard and fast rules in every single instance. So I built essentially a very detailed model, a spreadsheet model, which kind of looked at all these principles and gave them primitive sort of, weights, and or at least forced me to ask and answer the questions systematically before making any investment. That was kind of the first iteration of all of this. That was version 1, and I'm now up to version 45 of that model. And I only have a version change when I roll up several changes, so there's been a heck of a lot of iteration. But it's become a lot more sort of, as I said earlier, a little more scorecard oriented, because I think one of the problems that I discovered, one of the big problems, was that you can ask all the qualitative questions you like, But if you're going to answer them through a lens which has you seeking the very thing that you want, i.e. confirmation bias, then you're not being intellectually honest with yourself, even though you think you are. In fact, even the mere act of asking the question, knowing that you'd like to actually do something with this company, you do actually want to buy it, otherwise you wouldn't be looking at it in the first place. So then to ask a series of questions with that already in your head is going to lead to bias. And so that was the inauguration of the scorecard approach, because that way I sort of formed a scorecard, and I've got all of these weights, but I hide the weights. So I actually built the thing, and then I've like hidden the weights. I don't even remember now how I've actually weighted those questions. And I do that deliberately because I don't want to game myself. I mean, I tend to go through these questions, and you know the questions, and you think, well, I'm just going to answer the questions in the way that actually gets me to the state where I get a score where I can buy the stock. I mean, it's an inherent problem, you know. So I think anything that you can do to remove these biases is a good thing.
Yeah, and if I'm allowed to ask, or I'm allowed to know, like, what have been the biggest changes over your scorecard from version 1 to 45? Like, what have been the biggest things that have moved?
I think the biggest thing probably, so initially there were just a few questions. In fact, that was the whole point of this. The whole point of this was not to have question inflation. It was to basically just distill the investing process down to just a few actionable elements and not complicate stuff. And just try and distill it. You know, what is the essence of what you want to buy, and why you're buying it, and what price you're buying it at. That's it. You know, what I've found though is that if you ask very high level questions, like, you know, things like, well, you know, does it have a moat or something like that? I mean, that's a very broad question. Well, you know, you can make up almost any answer you like to that. It's one of these sort of woolly questions which, you know, unless you sort of go a lot further with it, I just don't know how you can action something on the basis of that, asking and answering that specific question. I mean, you've got to identify the nature of the moat. Is that really a moat? What is the intertemporal nature of this moat? Is it going to be stable over time? What, you know, I mean, can we even answer that question? So what I found was that I had to break the questions down into smaller bits, and then I would give each bit a weight. And each bit of that weight might actually, in some way, contribute to the overall mass of the question. But I also have to stop myself from gaming myself in this process by knowing the weights, and therefore actually undermining myself in my selection process. There's probably lots of other ways to do this. Look, I mean, that's another broader question, you know, that I'm thinking about at the moment, actually. Like, I've got this scorecard approach, which I think is a reasonable way to approach the problem, and it has worked pretty well, actually. It's kept me out of a lot of problem situations, you know, and it's also, you know, caused me to you know, own something for a long time and ultimately sell it on the back of some subtle change in factors as part of the overall scoring mechanism, which I can't actually point to which factor it was because I'm not looking at those weights, having already formed the weights in the past. But I know that basically, you know, this situation is clearly deteriorating, and that's something I might not have seen otherwise. I might have just sort of, you know, swept it under the carpet in a past era and said, you know, yeah, you know, overall it's still pretty good. Let's just hang on to this. But I think it helps me guard against thesis drift a little bit, which is a good thing.
Yeah, so how much do you push it back against the scorecard? Like, how much are you willing to put your foot down or go with gut instincts, or is it live by the scorecard, dive by the scorecard?
Never. No, I've decided that's, look, every time I've done that, I've lost money. So I just think it's better to be disciplined. Look, the cost of the discipline is that you will once in a while come across something that I'm going to use the word I hate using, which is intuition. Because intuition is really just a hidden algorithm that you don't understand, right? I mean, it's just something going on in there which may have validity or may not. But anyway, intuition. So once in a while, you'll have intuition about something. And that something will actually turn out to be correct, you know, and it may never have basically passed your scorecard or any of your rigid metrics or any of that sort of stuff. But that's you know, I'm happy to pay that cost of omission to get rid of the cost of commission, which is to make extreme errors from intuition that just are ruinous. and involve, capital wipeouts and all that sort of thing. So it has kept me out of trouble. Look, I definitely won't be able to buy some assets which are clearly going to be incredible performers. And some things do get away from you because it could be just something as simple as it just doesn't have enough seeded history. I mean, this is a common problem for me because there are qualitative and quantitative elements to my scorecard. And if I can't get enough of both of those flowing through, particularly the quantitative, it's never going to make the grade. It's never going to get past the threshold. That's always difficult with new businesses. It's difficult with things that have just IPO'd out of nowhere. It's difficult, for businesses where there's been some major acquisition. It's difficult for situations where there's a spin-off where the embedded history of the business wasn't there previously. There's lots of reasons for why it's a problem. So it is an issue, but it keeps me out of trouble.
Yeah, no, that's great. And to talk about management, maybe, like I've heard you speak a bit about attending AGMs abroad, and even our connection who put us together today originally met you at a Berkshire meeting, so massive thanks to him as well. But what do you think you could learn maybe from physically attending the company's AGM, or any specific examples where it's helped you or helped maybe avoid situations? Like, how do you view that?
It's always interesting. It's always interesting. I mean, it's full of what I call random edge networking. I mean, anything can happen at those sort of things. You meet lots of interesting people. I mean, sometimes you'll be seated right next to some profound insider in the company, this sort of thing. There's lots of possibilities. You get, I think, an opportunity to see the whites of management's eyes, so that's helpful. I mean, there are other ways to sort of investigate culture and all that sort of thing. I'd say probably the number one difficulty for me in my investment approach is understanding a company's culture. This is the hardest thing to distill because, unless you're actually working there, I mean, how the hell do you really know what's going on? It is very difficult. And going to the AGMs, that helps. I mean, they're obviously, they can be very scripted events, and the actual content may not be relevant at all. But you do get to speak to people. You do get to ask questions. It's helpful. You'd be surprised, you go to some of these AGMs and the behaviours are just so bad that you just think, well, I'm glad I came to this AGM because I'm certainly not investing in this company. There's one particular, actually, that brings to mind one particular company. There's a Hong Kong company, actually, a group called Pico Far East. I don't know if you've ever heard of them, but they are pretty much the leader in the exhibition design and services space. So what they do is all of those sort of very fancy, display booths and associated paraphernalia, all of the sort of premiums and all that sort of stuff that's at any kind of massive trade exhibition, of which there are just an astounding number of trade exhibitions globally each year. These guys have a really big share of that marketplace, particularly in Asia Pacific, and they're the best. And so they're an interesting company with a peculiar kind of a niche. And I mean, lots of things have happened, since I was looking at that company, but this was probably back in around the 2017 timeframe. Meeting was in Hong Kong, and I thought, okay, I'm going to do quite a lot of work on this company. I'm going to go to the AGM. There was an activist on the register. He owned just over 5% of the company, and I wasn't sure whether he'd be at the meeting or not. He was always sort of, pressing them for some changes and various things. So, okay, let's go to this meeting. And so the activist was there, and this guy's a very smart guy. He's incredibly thorough, does an enormous amount of work on the companies before he invests. So I figured he'd done a lot of the homework. I'd done a lot of work on it. I'd done weeks and weeks and weeks of work on it, and went to the AGM, and the chairman was totally evasive on all questioning. Totally evasive. And the activist, this is the guy basically who owns more than 5% of your company, and he just wouldn't answer the questions, or he would just, obscure the answers. And they're pretty basic questions. It wasn't anything particularly, confronting. They were reasonable questions about, shareholder dilution and, all sorts of rights that are peculiar to the Hong Kong market, really. And then I decided, well, look, maybe it's a bit confronting with the activist, so I'm going to ask him a more general, open question about strategy. And I got shut down as well. Not totally directly in my face shut down, but enough to basically say, okay, well, we're just not going to answer this question, basically. And So at that point, it's pretty uninvestable, isn't it? I mean, it's just difficult for me to get my head around a situation where the shareholders just don't matter to the management. It's a dangerous situation. There are better things to invest in out there. Better stories, better governance. I didn't invest.
Anything maybe on the flip side where maybe management have convinced you somehow, or?
I think one company that was a lot like that, actually, where I may have taken a lot longer to form a positive view on it and actually commit capital to it. But by going to the meeting, I mean, this is the precise opposite situation, right? The CEO of this company is a profound communicator and an educator and wants to bring all the shareholder base along for the journey. And he'll spend more than an hour, actually up to 2 hours, I think that meeting goes for, just talking about every aspect of the portfolio, what's going on in this business. This is a business that's actually, you probably know it. Do you know Markel Corporation?
Yeah.
Yeah, so baby Berkshire Hathaway, really. And they have modeled themselves on Berkshire Hathaway, and they are in very similar business lines, just with a lot less scale. But, he takes great pains to, explain what's going on in the portfolio. They've also attempted to buy more unlisted operating businesses these days, almost like a venture capital sort of operation, and private equity really. But and they, there's a lot to talk about in those businesses, and they bring you along for the journey. In fact, that's a meeting that's just, it needs to be attended by a lot of investors. I think it really is a lesson in how to run things properly.
And even like you mentioned before, the optionality of meetings. I never even thought about it that way, but that's such a great way of putting it. Like the people you meet along the way or the insiders. Yeah,
it's surprising. I mean, and just not just that, but just other investors in the audience. I mean, look, good management attract good investors, attract other good investors. And so there's a big network effect here, and you're in the room with people who have self-selected to be in that room, and they are naturally on the same wavelength as you. It's possible you're going to be in a giant thought bubble. It is possible, but they are nonetheless generally pretty interesting people to talk to, and you can learn a lot. And I have.
I've never thought about it that way, but that's such a good way of putting it. I love it. So maybe when you made the move from more quantitative to qualitative, like why make that jump? What made you, like, walk me through that process? Why'd you do it? What was it like? Yeah.
It was a slow moving process and I probably should have done it a lot earlier. So I always thought, working for the banks, doing arbitrage, and I've done lots of different types of quantitative trading techniques in these institutions. So-called multi-strategy hedge fund techniques, really. Everything from the derivatives arb stuff, the options arbitrage, convertible bond arbitrage, risk arbitrage, or the merger stuff, to statistical pairs trading, all sorts of things. We've covered a lot of stuff over the years. All of it interesting, but in the end, I concluded it's picking pennies up in front of steamrollers. I mean, this is the problem, and you are working for relatively small but fairly certain returns, probabilistically predictable returns. They're fairly high frequency, which is great, but in the end, I mean, what you're not getting is these long-term compounding effects, and it's better to be in the long-term compounders. It's just an easier way to make money. So I'm going to describe broadly. My time doing all that sort of stuff was a lot of fun and very intellectually satisfying. But I think in the end, it was a bit of an intellectual indulgence. And I think it probably would have paid me to just think about, these longer term sources of compounding gain a lot earlier in my life.
So then how did you approach maybe volatility and the risk? You said pennies in front of a steamroller, like going to longer term holdings. How do you handle it?
Well, this is I think another one of the famous sort of mental model discussions, isn't it? So I think what you have to do is you need to have a decision-making framework which is uncorrelated with the thing that you're actually deciding. That's the key to this. I mean, you've got to do that at some level. So to put it into concrete terms, so I think you come from a background where you were doing a little bit of momentum trading, this sort of thing, right?
Yeah, exactly.
It's essentially a function of the market itself, right? I mean, the thing that you're actually actioning and all the data to support that decision is itself the market, more or less, right? There's a strong feedback connection between the two. I mean, sometimes people will be doing momentum of earnings, momentum of this, momentum of that, but in the end, I mean, like, and particularly a lot of technical trading systems, obviously perhaps a better example really, but those things are obviously a function of market price level themselves. So what I've tried to do is find a decision-making framework which is uncorrelated with the market. And then, I mean, nothing's ever totally uncorrelated. Everything's correlated at some level because at the end of the day, we're sitting on this planet, and everything on the planet's fundamentally correlated at some level, right? But for the most part, in financial markets, I mean, if you can actually arrive at a decision-making engine which isn't actually the market price itself, and the market price is not a direct input into that engine, then I think that you can make the decisions irrespective of where the market price actually is. And the market price then becomes an opportunity. Volatility becomes an opportunity rather than a risk factor. So I don't see volatility as a proper surrogate for risk. In fact, it's the wrong, maybe that's the wrong way to describe it, because in the end, volatility of price I don't see as a surrogate for risk, but volatility of underlying company metrics I would view as a surrogate for risk. And in fact, it's one of the elements of my screening system. It's like, well, you know, if they've had volatile earnings history, but volatile earnings history may or may not correlate to volatile price history. It might or it might not, you know. In any case, I mean, you know, I think that volatility is something which is a convenient measure for risk, but just because it's convenient and available doesn't mean you should use it.
If I'm allowed to ask, any quirks of the scorecard that you think other people don't look at maybe, or?
You know, I don't think there's anything that I'm doing that's just totally unique and different. It's an amalgam of what other people are doing, because at the end, how many original thoughts can anyone really have? I mean, we're all an amalgam of every thought everyone's ever had, right? Everything we've ever read, every conversation we've ever had. So in essence, I mean, it's all just in the mix, isn't it? It's the recipe. So I think it's less about the scorecard, actually. I think the scorecard or any decision-making framework you want to use, whatever your models you're using and all that sort of thing, I think they give you a disciplined framework to operate in. But there's so much more than that. I mean, I think it's really about harnessing lots of other factors around. How do you make decisions in extremely difficult circumstances? How do you actually can you rely on this framework, this model, whatever you're doing, in circumstances of extreme market stress? That's the big one, isn't it? I mean, that's the big one. I mean, how are you going to do it? I mean, you know, the market's down, you've just dropped 50% of your money. Can you purchase more at that point?
Yeah, great way of putting it. And is it almost a bit of, sometimes you got to know the rules in order to know which rules to break or bend, you know what I mean?
Yeah, I mean, I think, well, this is it. I mean, but I think it's difficult. This gets to the heart of decision making. So what is it to make a quality decision? How do you make a quality decision? Does it have to be completely rigid? Do you have to preform every possible factor that goes into that decision before you even get anywhere near the decision? Is it okay to bend the rules once in a while? Is it okay to occasionally look for exceptions? I suppose there's always going to be some sort of exceptions. But the more times you basically drift from your framework, the greater the risk that you're just going to drift into insanity.
Yeah, great call. No arguments from me. Is there any aspects of investing and what you do that you think are either pretty easy or come naturally to you? Like what might look very hard from those outside looking in that you enjoy doing, do you reckon?
Yeah, that's an interesting question. I think like it's been said that the great investors have the 3 T's, as they say: time, training, and temperament. Right. So time, looking at the investments, which most people are pretty time poor, so that's a difficult one in the first instance. Then you need some training. You do need some basic financial training if you're going to do things like look at company fundamentals. You need to understand some accounting, whatever you're doing. But then there's the temperament. The temperament's the hard one. That's the hardest of the 3 because it's hard to acquire it, and I think probably there are just some people that are hardwired with the right temperament in the first place. So in my case, I mean, I definitely have a contrarian mindset by nature. So I just naturally gravitate towards, the opposite to what the consensus thinks or does. That's not to say that contrarianism is always right. I mean, being a contrarian just for being a contrarian's sake is absolutely not a bankable strategy in life. It'd just involve lots of arguments probably. But, I think exceptional returns do require two things in the end, right? You've got to have a different view. I mean, you've got to have a different view to the market, and you've got to be right about that view. And there's no point just having the same view as the market. I mean, otherwise you'll just perform with the market. So I think a contrarian mindset, I mean, to put it in more precise sort of terminology, I mean, it's being a contrarian, I think, is a necessary but not a sufficient condition for investment outperformance. Simply because you're going to have to do something different to the market in the first place to be different to the market and to beat the market in some fashion. And if you want to be a contrarian, I mean, I think you've got to prepare yourself to act in the face of completely unprecedented events and in the absence of perfect information. And it's always like that. I mean, it's just difficult. There's just no circumstance, all the great opportunities for investing money in markets occur, at some time of stress. And there will be maximum uncertainty. The markets always hate novelty. They hate novel events they react to novelty. So they react to novelty disproportionately positive when it's something good and disproportionately negatively when it's something bad. And so things like the global pandemic, that's a classic case of market novelty. Haven't seen it before, certainly haven't seen it in modern market terms. The last time we saw anything like that was probably 1918, the Spanish flu. And even then the markets were a fraction of the size they were, and it wasn't as, there wasn't the communication. So that event, that looks scary at the bottom. That looked very scary. I mean, and who would have predicted the events that occurred in the months after that?
Yeah, and I think it was Mike Tyson who said everyone's got a plan until they get punched in the face. So can you even prepare? How do you prepare?
Look, I think the only way that I've found to do it, I mean, this is the issue, right? So you've got to develop a conviction in what you're doing, and an investment conviction, which is going to overwhelm your natural resistance and all your emotional fears at the point of the decision making. So there will be the great test, there will be the great opportunity. And the only way to pull the trigger at that point is to have the confidence in the decision because of all the work you've done in the past, or just the sheer amount of time you've been following the business, and you've been looking at it for years and years and years. You almost have to basically go kamikaze at that point. You have to say, well, you know what? I'm just going to invest because really, if this fails and this doesn't work, then nothing works and it's all to zero anyway. So let's just go for it. That's the kind of headspace you've got to get yourself into. It's never comfortable at the bottom. It's just not comfortable. And if it is comfortable, it means it's not the bottom.
Yeah, that's great. I love it. I just love this. This is so good. Maybe start talking about how you started Enlihtan and why you decided to go out by yourself. Just walk me through that whole process. What was it like? Your thinking through it? I'd just love to hear the background and story behind it.
So the roles that I had at the financial institutions, and probably especially CLSA, that was a very outsider kind of role anyway. So the team that I was running at the time was very much an outsider looking in, and that was the era after I'd already discovered Buffett. So what was going on with me was, we were running these sort of internal hedge fund at CLSA, if you like. And doing all those sort of classic sort of hedge fund sort of things, all the arbitrage strategies, and that was my day job. But my night job would be to invest my own money according to these sort of Buffett-esque sort of principles, right? And that went on and on for years, So day job and night job. And then eventually I just got to a point, and it was a natural exit point at CLSA anyway, but I got to a point where, I decided, look, if I've got some capital and I've got a plan for how to run that capital, well, then I might as well just run the capital and open it up to some external investors because that's what I'm going to do anyway. So why not? And so I started the fund. And I think that it was definitely tempting just to just say, okay, I'm just going to run it like a private family office here and just, run my own money and just not have any external investors. But there's some value in having external investors. External investors basically give you a level of accountability and rigor that you wouldn't get otherwise. I mean, I think that the process of, for example, writing a quarterly letter enforces a clarity of thinking and a need to justify actions or a lack of actions. It's something that I have to sit down and write, and writing brings great clarity to thinking. So although it seems like a bit of a pain to have to do all those sort of things, and there's compliance and there's other things happening, I think having sort of the merry band of followers there, knowing that they're there and knowing that you need to write to them once a quarter is a valuable process.
Yeah, totally agree. And is there anything you wish you knew earlier or wish you learned earlier? Like, what advice would you give to someone starting their own fund, I guess, maybe?
I think probably the number one thing would be not to view the funds management business as a means to an end. I think plenty do, mind you, and plenty are successful, right? So I'm not saying that this is going to be a doomed strategy if you go down that path, but I just think there are essentially two ways to go here, right? You can start a business, with a funds management business, with the idea of getting a big business, which means you might do lots of things like sell lots of strategies that are in vogue. In fact, you would design strategies for sale. You'd be like a consumer products company. You'd say, well, here's my funds management business. I'll treat everyone fairly and equitably, but at the end of the day, I'm going to run the products I think sell, and sell means raise lots of money and get lots of fees, right? Or you can say, I'm not going to do that. I'm going to run a fund. And the funds management business is there, but it's not the most important aspect of this. All of the primary effort is on actually running the fund, right? That's my approach. Now, in reality, all these any of these businesses are a blend of the two. There has to be a blend of something. You can't run the fund without running the business. I mean, you can't be completely, lax on one versus the other. So there's always a blend, but I think that I definitely fall into let's run the fund for the fund's sake, and that's because I'm the biggest investor in the fund. I think that it would, I suppose my advice would be, look, don't be tempted to maximize your own circumstances at the expense of your investors. I mean, I think that's the issue of sort of if you focus first on the business, you'll be tempted to go down that sort of a path. So I view it more as a way of life, a partnership with the investors, and thus the sort of the focus on running the fund, which is really just an extension of running my own money, really.
Yeah, fair call, and totally agree. And probably a common complaint with people running their own fund, I think I hear a lot, is they didn't realize how much business side of it versus investing. Like, how do you view that? Like,
well, I am the virtual fund here. I mean, I really am. And I've outsourced everything. I've got service level agreements with everybody. I don't. I've tried to automate as much of it as I can. I keep it very lean and mean. I don't spend there's definitely there's a steadily growing compliance load, and that's just throughout the entire financial services sector. I mean, every time there's one bad actor somewhere, it just adds a new layer of regulation everywhere. It's a pain, right? And we've got, in the time that I've started this fund, we've gone from, some simple sort of, withholding sort of forms, once every couple of years or whatever. Now you've got FATCA, you've got CRS, you've got all this know your client, all this due diligence stuff. I mean, the amount of the effort to onboard somebody in a financial institution now is just ridiculous, but it's just the world we're in. So there's a little bit of action there, but I don't have an enormous number of investors. They are large and concentrated. They're all very, very sophisticated. I mean, they rarely, if ever, pick up the phone and call me about the fund or any of this sort of stuff. It's a pretty easy thing to manage if you have the right clientele in the first place. So this is the other problem. I mean, and this would be true, I suppose that's another aspect of starting any business, but certainly, starting a fund. I mean, if you have difficult clients, you will have a very difficult life running a fund. I mean, lots of clients phoning up, complaining every time the market goes down 10%, this sort of thing. That just doesn't happen in my case. I mean, I write to them quarterly. I'm very forthright about what's going on. They know what's in the portfolio. It's all very clear. I think people appreciate that level of clarity.
Has that been a deliberate action since the start, or has it been a happy accident? And how do you achieve that?
No, I started it out that way. One of the So one of the biggest fears I had actually before I started this business was just the fact that having difficult investors. I mean, having investors just, phoning you up every time something goes wrong or the markets are a bit volatile, or certainly if they go down 30 or 40%, I mean, they'd just be in a great panic and just want to withdraw all their money, that sort of thing. And that's not what they're signing on for. I mean, I've certainly gone to great lengths to explain the investment process and why it's a long-term process and what should be expected from that process. And that seems to have worked pretty well. I think it is difficult basically to attract the right sort of client base in the first place. So but part of the conceptual problem in all of this, and which is kind of this is the cynic in me. If you spend enough time in the finance industry, you become profoundly cynical. The issue for all fund managers is that you're fundamentally trying to do something in the marketplace which exploits some sort of psychological anomaly, right? That investors are buying things at the wrong price and that there are a bunch of irrational people and you're the only rational guy in the room. That's the fundamental premise for why you would enter a marketplace, right? Otherwise, if everyone's rational, what's the point? So you think everyone else is irrational. But unfortunately, the same people that you're engaging with in the broader marketplace are also your potential investors. So what you really want is hyper-rational investors and extremely irrational marketplace. And that's a difficult combination to get.
I got to ask, what do you have any favorite things to do outside investing? Do you ever switch off? Because, you just seem so into it. I'm just curious.
Yeah, I mean, I do. I have what I'd say 4 quadrants of activity, right? This is kind of my big plan going forward. This is my feeble attempt at work-life balance here, right? Which everyone seeks but never seems to get to. And I've got to say, it's harder than even when you can articulate it. It's still pretty hard to actually do it. So I've got the finance stuff, which is the funds management, and so these are my 4 quadrants. I've got the finance stuff. I've got math. So I still mess around with quite a lot of mathematics, and I've got some computer science stuff that I'm doing, and I've got philosophy. And all 4 of those interact in various interesting ways, mostly not at the same time, but also in unusual ways from time to time. And sometimes one is an enabler of the other. So those are my big 4 quadrants. I spend almost all of my time, in one of those. And the best days are situations where I'm probably in 2 of those quadrants, which probably gives me the greatest satisfaction. Outside of that, though, I'm very into sci-fi and movies and all that sort of thing. Quality wines. Life's too short for cheap wine. Yeah.
No, that's perfect, mate. Just making sure you're still human, because this whole conversation, I'm like, man, you're a machine. This is unreal.
Not at all.
Maybe move into my closing round of questions and just some broad, general, what do you think is the most undervalued life experience that university-age students don't give weight to? What's an underrated skill or experience that you think they should have?
I think I'd say their ability to present well-reasoned arguments, especially in a public setting. So in short, public speaking, I suppose. It is underrated. I mean, and it's probably increasingly underrated because of the presence of, lots of personalized media channel and all this sort of thing, your ability to sort of get on a one-to-many platform sort of environment and just deliver your message to the world. But the ability to actually communicate to an audience live or semi-live, I think is very underrated and not taught anywhere, really, is it?
Yeah. So how do you think someone learns? How have you learned? Because you're a great speaker, I thought. So.
Well, I got to say that one of my great ambitions is to be able to do that sort of thing and not be nervous about it. It's one thing to do it. It's another thing to be doing it without having knots in your stomach. And I think I don't know why it needs to be like that. It's an interesting conundrum, isn't it? Because you get up in front of an audience and the audience actually wants you to do well. There is no circumstance where the audience does not want you to do well, because if you do poorly up there, you actually make them feel very uncomfortable. They're probably more uncomfortable than you are if you perform poorly. So nobody wants you to perform poorly, and yet, you get up there and it's actually nerve-wracking. So it'd be great to somehow diffuse that. I just don't know how to do that.
If it makes you feel any better, I'm 20 podcasts in and I still get sick before every podcast episode. I don't know why. No matter how much research I do.
Blame your biological programming.
Yeah, I will for sure. Because it's just one of those things maybe just learn to live with it, I guess, because for me it certainly hasn't gotten any better, and no matter what I do beforehand.
Yes, well, it's a work in progress, I guess.
Maybe just in terms of informational sources for you, we've spoken a bit about some of the books you've read investing wise. Have there been anything else that have been maybe influential in shaping your worldview, or anything else that you'd really recommend?
Well, I think that from a very young age, so I had a fascination, probably a bit of an unnatural fascination from like pre-teen sort of era, with the oddities of things, particularly things to do with space, relativity, and even quantum physics before I even knew what that really was, but just some of those ideas, without understanding any of the, the math behind it or any of that sort of stuff. But I was introduced to the ideas fairly early through books, and I just found that totally weird. I mean, just the implications for what it means for the reality we find ourselves in. So that has definitely transformed my worldview. Reality is a very weird place, and we only have a very limited view of it. But look, more generally, I would say that reading, reading all of in the philosophy realm. So reading sort of the great sort of the great philosophical ideas from past eras. So things like the Greeks, maybe the Stoics, this sort of thing. There's a fountain of information there from those different eras. All of those things have had a big influence on the way I think. I mean, at the end of the day, as I sort of hinted at earlier, I mean, how many original ideas can you really have? Is there any question that any of us can ask in this era that has not been asked at some point in all the history of humanity? And thus probably answered, maybe not to your liking, but it has been attempted. So you can go back and look at some of that stuff. It's all there. We've been around for a long time.
That's such a great way to wrap up. And honestly, I'm going to be thinking about this conversation for ages. So Matthew, thank you so much today. It's obviously late for you as well, so thank you so much.
Not at all. It's been a great pleasure. Thank you for having me on.
Anything you want to plug or anything, or where can people find you?
Well, I've got my website, www.enlihtan.com, which is a very unconventional spelling of enlighten, Enlihtan. That's actually the 14th century French spelling. That's how difficult it was to get the .com even back in 2010. So my quarterly letters are up there if you want to subscribe to those, by all means. I mean, that's open to everybody, not just my investors.
Perfect. Thank you so much, Matthew. I'm going to be thinking about this conversation for a while, so thank you so much.
Thanks, Kalani. I had a blast.
If you enjoyed this podcast episode, be sure to check out the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. Either way, links to all content mentioned will be in the description below. Also be sure to sign up for my weekly newsletter, curated by Kalani, where I share what I've been reading, learning, and watching for that week. Same as the podcast, it's compressed to impress, and I aim for maximal return on your time invested. Sign up at kalanis.substack.com. So that's KALANIS.substack.com. You can also connect with me on Twitter at ScarrettKalani. But until next time, have a good one.